He's one of the most feared and mysterious traders. An aggressive style, unmatched decision-making speed, and courage to take massive bets helped make him the most profitable day trader in the world. Incredibly, his hedge fund, SAC Capital, made around 30% annually net of fees from 1992 to 2013. But there was also a dark side. This is the fascinating story of Steve Cohen. First, we'll look at his early life, then we'll break down his powerful trading strategy, and lastly, we'll look into the darker side of his story. Steve Cohen made billions and achieved incredible returns, but his journey is also filled with mystery, controversy, and a legendary comeback. Part 1. Steve Cohen's early life. 1956. New York. Steve Cohen was born into a modest family, but his fascination with managing risk started early as he started gambling in high school poker games. He would often spend the whole day and night playing while earning thousands of dollars. Despite staying up late playing poker, Cohen would achieve good grades and enroll at the University of Pennsylvania, where he graduated in economics. But he was still hooked on poker. Young Cohen found playing poker to be his favorite hobby, which he could also earn a substantial income from. However, he wanted to take on a bigger challenge by trying his hand at the financial markets. Right after college, Cohen joined Grunthal & Company, which was a small investment bank. His role was as a junior options trader, and within months, his talent stood out. Soon after joining, by 1984, he was already running his own trading group inside the firm. Cohen often made $100,000 a day through rapid-fire trading, quickly building both his reputation and personal fortune. $100,000 daily. That's not bad to say the least. But he had a major problem. Cohen became tired of working at the investment bank and knew he had what it takes to execute his strategy in his own company. So, in 1992, Cohen launched SAC Capital Advisors with $25 million, a portion of which came from his own pocket. SAC wasn't a traditional hedge fund, though, as it was developing a high-speed trading machine. Cohen's traders would often hold positions for only a few days, sometimes hours. By the late 1990s, SAC was trading 20 million shares a day. And by 2006, it was responsible for around 2% of all U.S. stock market activity, which is incredible. The fund became known for its high-risk, high-reward approach. Over 2 decades, SAC expanded multiple strategies from long-short equity to fixed income and quantitative trades. Incredibly, his hedge fund, SAC Capital, made around 30% annually from 1992 to 2013, which was net of a 3% management fee and 50% performance fee. This return meant he was easily one of the best traders in the world. But how exactly did he do it? Let's dive deeper into his strategy in the next part. Part 2. Uncovering the trading strategy. SAC became famous for lightning-fast executions by taking advantage of opportunities that existed for only seconds. A unique mix of short-term precision and long-term strategic patience allowed Cohen's firm to thrive in a competitive and rapidly evolving market. His strategy embodies one of his biggest lessons for traders, which is to evolve and adapt to the market. The foundation of Cohen's success is a structured, almost surgical approach. Unlike many traders who try to fight market direction, he prefers to move with the flow of momentum. Cohen's philosophy is simple but powerful. He understands market cycles and acts when the time is right. He patiently waits for momentum to peak before shorting, and looks for technical base formations before buying back in. It's less about guessing the top or bottom, and more about aligning his trades with volume shifts that signal when a trend has real conviction behind it. Key pillars of Cohen's strategy include tracking momentum to ride established trends while being patient to wait for confirmation before making a move, and volume analysis to help execute trades at critical inflection points. Cohen's edge begins with vast amounts of data. Instead of relying solely on classic chart reading, his strategy uses automated systems, programming languages, and advanced algorithms to detect subtle market signals most investors can't see. Traditional technical analysis focuses on reading price patterns. Quantitative trading takes it further. It builds mathematical models that dig into the underlying forces driving price movements, uncovering opportunities hidden beneath surface-level trends. His team relies on vast amounts of data, including historical pricing record, news sentiments, key macroeconomic indicators, and technical metrics on different assets. To process all that information quickly, Cohen's operation uses high-performance computing, with very advanced processors for machine learning and secure cloud infrastructure. The combination of data and computing power allows trades to be executed in milliseconds, which helps turn tiny inefficiencies into huge profits. Steve Cohen's approach is built on a few core principles. deep quantitative analysis, strict risk control, and the ability to pivot quickly. Markets change fast, and Cohen's edge has always been his ability to spot new trends before most others notice. Additionally, a significant part of his success is from being able to assemble specialized teams. He hired top experts in everything from statistical analysis to computer scientists who build and refine algorithms to detect market anomalies. These aren't your average traders with a few screens. Instead, they are some of the world's best quants who live and breathe numbers. His team develops advanced algorithms capable of making complex decisions faster than any human could. Instead of relying on emotion or instincts, they use programmatic models to identify patterns and correlations that traditional technical analysis might miss. Paired with solid fundamental research, it gives him a strong competitive advantage. The models dig into massive data sets, uncover hidden patterns, and measure market sentiment in real time. Cohen's fund mixes machine-driven analysis with decades of trading experience. Cohen has an uncanny ability to spot asymmetric opportunities, where the upside far outweighs the potential loss. Calculated risk management shaped him into one of the most formidable traders on Wall Street. Cohen's strategy is driven by collaboration and speed. A major example of Cohen's skill came in 2008 during the crisis. As panic spread through the market, most investors dumped their positions in fear. Cohen, on the other hand, began buying quality companies at very low prices. He was anticipating that these undervalued assets would bounce back once the chaos subsided. This contrarian move paid off well as the market recovered. If you're learning something new, feel free to click the like button. Thanks. A lot of traders talk about risk management, but Cohen lives by it. Since he was a boy playing poker in high school, he has remained very interested in risk management and calculating probabilities. His framework focuses on diversification and adaptability, using quantitative models to predict potential market shifts. For example, during the financial crisis, while others were reacting to falling prices, SAC were methodically accumulating positions. He followed the data, which showed substantial fundamental value beneath the panic. Diversification across asset classes helped stabilize the portfolio, even in extreme volatility. In his early years, Cohen was known for high-frequency trading, but over time the landscape changed. Regulations tightened, algorithms became more widespread, and the competitive edge of raw speed began to shrink. As a result, he began to integrate longer-term positions and shift toward strategies built on deeper analysis rather than speed. Cohen became well known for identifying market momentum early and acting fast. During the late 1990s dot-com boom, SAC achieved around 70% returns by riding the bubble. But more impressively, when the bubble burst, they shorted tech stocks to profit too. Perhaps the most famous move came in 2012, when Cohen placed a massive $26.7 billion bet on Ardea Biosciences. Just weeks later, AstraZeneca acquired Ardea, and Cohen's position skyrocketed to nearly $40 billion in value. Cohen's team traded at a scale few could match, as they were moving 100 million shares daily at one point. But not every trade was a winner. SAC took big losses on several biotech bets in the 2000s, including Human Genome Sciences. High stakes came with high risks, but overall, the wins far outweighed the losses. Part 3. The Dark Side. Suddenly, Cohen had a huge problem. In the late 1980s, he drew the attention of the Securities and Exchange Commission over allegations of insider trading. He was called in for questioning, but invoked his right to remain silent. However, it didn't end there. 2008. This would be the year SAC invests $700 million in pharmaceutical companies Elan and Wyeth to develop a treatment for Alzheimer's. When disappointing clinical results were announced, both stocks collapsed, but something strange happened. Remarkably, SAC didn't suffer the blow. In the week before the news, the fund had liquidated nearly all of its positions and even shorted the companies to profit $275 million. A promising young portfolio manager called Matthew Martoma would end up predicting the crash, and as a result, he would take a $9 million bonus. But how did he do it? Essentially, Martoma would use networking companies that specialized in connecting finance professionals with experts in other industries who can help provide market research. This is legal, as the information was public information. But this wasn't enough for Martoma. He wanted more, and as a result, he began communicating with doctors working with Alzheimer drug trials. Martoma knew if he could find out more details about the progress of the drugs, he could profit massively, which is what he did. But such a substantial profit with great market timing caught the attention of regulators. As a result, in 2012, Matthew Martoma was found guilty by the SEC for insider trading. Prosecutors claimed Martoma received non-public information on the drugs trial results and advised Cohen to dump the stock before the announcement. But it got worse. Martoma was later convicted, served 9 years in prison, while having to give back $9 million in compensation. Cohen himself was never criminally charged, but the SEC did say he failed to properly supervise his employees. But in 2013, the case ended. Shockingly, 8 SAC workers were convicted of insider trading. As a result, SAC eventually agreed to pay $1.8 billion in penalties, which was one of the largest fines in hedge fund history. As part of the outcome, Cohen was barred from managing outside capital for 2 years. After SAC's downfall, many expected Cohen to disappear, but he didn't. In fact, he rebranded his investment operation in 2014 by launching Point72 Asset Management. For many years, the firm managed only Cohen's personal fortune, but after the ban was lifted in 2018, he started raising external capital. Cohen's trading instincts remained sharp, and Point72 grew rapidly, re-establishing him as one of the most powerful figures in finance. Despite the controversy, there are key lessons we can take from his approach. Here are some of the important takeaways I took from his story. He built his empire by embracing risk and volatility rather than fearing it. Cohen continuously developed his strategy with the latest technology to integrate quantitative models. Also, he surrounded himself with exceptional talent to stay ahead of the curve. Through legal battles and public scrutiny, Steve Cohen has remained a force. From the controversies with SAC Capital advisors to the comeback with Point72, he proves that resilience is just as important as skill. Steve Cohen's story is a mix of extraordinary skill, controversy, and relentless ambition. His hyper-aggressive trading strategy helped him become one of the wealthiest traders on the planet. SAC Capital's rise was spectacular, and its fall equally so. Yet, Cohen proved he could stage a comeback. Today, Point72 is thriving with over $37 billion in assets under management. Love him or hate him, Steve Cohen mastered the art of trading to become one of the most profitable traders ever. His story is both a playbook and a warning. $17 billion. That's Cohen's estimated net worth, which places him among Forbes' top 100 wealthiest people in the world. Beyond finance, he owns a large share of the New York Mets, making him a major figure, both in investing and sport. His story shows the heights a trader can reach with discipline, innovation, and risk-taking, but also how quickly it can all go away. Cohen's methods continue to shape how hedge funds operate. If you enjoyed the video, feel free to check out more incredible stories here. Also consider clicking the like button and subscribe. Thanks.